So this is a paper joint with Matt, who's also here with us. And I'm going to start with sort of big questions here, and if you allow me. And one of the big questions is who bears climate risk? And this paper focuses on the mortgage market because it's perhaps one of the largest debt markets. There's about $11.3 trillion of mortgage debt outstanding, $7.3 trillion in agency mortgage-backed securities. And so it's probably one of the first order questions is what is the exposure of the mortgage market, but also what is the exposure of the agencies to climate risk. And there's something that we want to explore, start exploring in this paper, which is the chain of securitization and the fact that mortgages are traded, they're securitized, they're put in pools. And so there's potentially a very large number of counterparties that are exposed to climate risk. And there's these theoretical questions about risk sharing. What should be the optimal amount of risk sharing between commercial banks, non-bank lenders, government-sponsored enterprises, and private label securitizers. We're also interested in understanding who is more informed. That is, we believe that there is asymmetric information about the current climate risk. I mean, there's development of a cottage industry of companies that are providing probabilistic measures of flood risk at the parcel level. And there's a real question as to whether those forecasts are accurate. How do we combine different forecasts into a single probability? And then there's ambiguity of future climate risk probability distributions. There's, Johannes mentioned this very important question of, is climate risk priced in? And there's some prices that are flexible, and then there are some prices that are rigid. And so we're going to talk about guarantee fees of the GSEs for the securitization of mortgages. And sometimes when prices are not fully flexible, that causes issues in the pricing of climate risk. And then there's a big adaptation question here. And this is here an acknowledgement of Matt's long research agenda about the adaptation to climate risk, which is to say who is adapting. Is it the lenders that are adapting? Is it the borrowers that are adapting? Is it the GSEs? Can the GSEs adapt, or are they facing some political economy constraints when using their human capital to really price in climate risk when they securitize mortgages? So I think the elephant in the room here is that if we want to think about asset pricing models, there's a large amount of regulatory intervention in the mortgage market. And there's a real, I think it opens the door for political economy conversation about if we want to change the way GSEs securitize mortgages, we're going to have to think about the design of political institutions. So these are sort of four big questions that we're going to be looking at in this paper. And so I want to start with a very simple and probably simplistic sort of a model here of the securitization chain, which is going from the borrower to the lender. There's an interest rate that is charged, and from the lender to the securitizer, and the lender pays a guarantee fee, which is the price of the securitization. And of course, there's many more arrows. I'm going to talk about the other arrows that are in the securitization chain. There's the insurance companies that we can talk about, but there's also the credit risk transfers where the securitizers can transfer back the risk to the private sector. And we're going to talk about those issues. So the key question of the paper is whether there's a market for lemons in local natural disaster risk. And there's one point of the distribution of loan amounts where we can observe the selection into securitization. And that one point is the conforming loan limit, which is the maximum dollar amount for a loan at which Fannie Mae can securitize mortgages. And it's set by FHFA, which which is supervising, regulating Fannie Mae and Freddie Mac, and it's set nationally. And there's only a couple of limits that give some spatial dimension. So it's not fine-grained variation in the conforming limit. So it's not reflecting the local climate risk. So that discontinuity in the ability to securitize generates a sharp discontinuity in lenders' ability to securitize their originated mortgages. And we're going to see that it generates a lot of bunching, that lenders are extremely aware of this conforming limit. And so they tend to originate a lot more loans right at the left of the conforming loan limit. And much fewer loans right above the conforming loan limit, where they can only securitize through private label securitizers. So here there's a little bit of a natural experiment as well, because the conforming limit is changing from one year to the next, and it's set nationally. So we're going to use this variation as well in the identification of the impact of climate risk on the bunching at the conforming loan limit. So questions we're going to ask now, narrowing down on more specific questions. Do local natural disasters lead to more origination and securitization of conforming loans relative to jumbo loans? So is there more bunching happening at the conforming loan limit? A second question is, are conforming loans better or worse risk? This is something we can observe using the monthly loan performance data. And then the third big question, which is, how can the GSEs, the government-sponsored enterprises, are responsible for so much of the securitization activity in the residential mortgage market, how can they adapt to the increasing and ambiguous climate risk in their guarantee fees, in their securitization policies, and perhaps also in the way they transfer the climate risk back to the private sectors with credit risk transfers. So a little bit of findings just before I delve into the methodology here is first, do local natural disasters lead to more securitization of conforming loans relative to jumbo loans? So we see a significant, economically significant, and statistically significant increase in the volume and securitization of conforming loans relative to jumbo loans. And we also see that when we look at the characteristics like the credit score, but also the ex-post default rate, that those mortgages that are more likely to be securitized after a local natural disaster tend to be more risky, both in observable dimensions and in ex-post performance. The impact lasts for multiple years after the event. And we also see, although the table is not on the slides, but it's in the paper, the impact is greater in places where it's a little bit of a surprise. So if we look at areas that are not typically affected by hurricanes, and here I'm thinking about Texas versus Florida, or Texas versus Louisiana. The hurricanes like Hurricane Harvey are historically not happening at the same frequency as hurricanes like Hurricane Katrina. And so we can use this measure of historical frequency to measure how much new news there is in a hurricane. And it's teaching banks where climate risk, banks and non-bank lenders, where climate risk is spatially. We find higher rates of delinquency and default for conforming loans. And then there's the big question of how can the GSEs adapt? So we provide a structural model of choice of mortgage, and which is like a second degree price discrimination model. And that allows us to generate counterfactuals. And that allows us to understand how much the guarantee fees that Fannie and Freddie charge should increase as climate risk increases. And then there's also something that they can do is use those credit risk transfers. And if we have time, I'll comment on this. We have some new evidence compared to the NBR working paper that is online. So we're going to focus on billion-dollar events. So we have events from Katrina in 2005, which was the largest event in terms of damages. So we have billion-dollar events from 2004 to 2012. For each of those billion-dollar events, we're going to look at the areas that are affected by these billion-dollar events. And there's a number of ways we can pinpoint the areas affected by hurricanes. One way to do it is to use the model that NOAA has developed. So Johannes mentioned earlier that there's these complex physical models that they're using. Here, it's actually a model that is remarkably good at predicting storm surge at the level of very small cells, and it's called the slush model. It's based on equations of fluid dynamics. They use the characteristics of the hurricane, and by comparing the predictions of storm surges to the measures of USGS water gauges, they can show that it's about within plus minus 20% of the realized storm surge. So the slush model is actually a fairly good model to predict the impact of hurricanes flooding on areas. Now we combine this with data from HUD. HUD has data on housing inspections. We also combine this with the wind speed data. There's a data set that is called the Atlantic Hurricane Data that collects information on the wind path of hurricanes since 1851. So that data set is great because it also allows us to get historical measures of hurricane frequency. And so it allows us to understand whether, for instance, to build these measures of why Florida is more likely to be affected and why Texas is relatively less likely to be affected historically over this very long time period. So we also have USGS elevation data from the Shuttle Radar Topography mission to measure the elevation of each 30 meter by 30 meter parcel. We have land cover data. The land cover data is particularly useful in places like Louisiana, around New Orleans, because the coastline is actually fairly far from the metropolitan statistical area. And so we need to incorporate the fact that there's wetland around New Orleans to capture the extent of the flooding. So we define the treatment group in two ways. One way is to use the slush model. Simply, this is just publicly available, downloadable data. The slush model gives you storm surge measures. The other way we do it is just an alternative way, is to use HUD's housing inspection measures and build a classifier to say, given the information we have about damages to housing units in specific hurricanes, during specific hurricanes, can we impute this to the whole of the Atlantic coast and the Gulf of Mexico to get a sense of which areas are affected by hurricanes. And so we combine three sources of data to build that classifier. One is the wind path, that's in dark gray here on this slide. The blue area is whether an area is coastal or next to wetland. And the red area is whether it's low elevation. So by combining those three dimensions, we get an estimate of which census tracts are treated, and then we aggregate it to the zip code level to get a sense of which 5-digit zip codes are affected by hurricanes. So it turns out that using this definition of the treatment group or using the slush definition of the treatment group yields very similar estimates. So if you're interested in the details, we're very happy to provide them, but essentially the treatment definition doesn't matter here. For the mortgage data, we use the data from MACDASH. We have about 65% of the market. This is data from servicers. The great thing about this data is that it gives us FICO scores, a monthly payment history, loan amortization structure, first and second mortgage. So here there's something to say, which is that in some specific areas, we observe that households are taking a conforming loan and then they're topping up their borrowing by taking a second mortgage, so that there's a first senior mortgage, which is conforming, and then a second mortgage, which is a smaller mortgage that allows them to get a greater combined LTV. We have 5-digit zip code data. And so we think it's important that the results are replicable given the impact that the paper has had on the policy discourse. And so the results are fully replicable using the HAMDA data, which is publicly available. I'm saying this for the audience here, that they can replicate the results of the paper using HAMDA data. It's got larger coverage, it's more granular, but there is no performance history. So MACDASH is necessary to understand that after hurricanes, we observe in our time period that there's more prepayment and there's more defaults after a hurricane. And we match the HAMDA data to lenders' balance sheets because we can see who is actually securitizing mortgages. And so I'm going to report some information about what kind of banks are originating and securitizing mortgages in the conforming segment, and what kind of banks are originating and securitizing in the jumbo segment. So first, a graph of the bunching of mortgages at the conforming limit. So on the, this is from the HAMDA data, and on the horizontal axis, we've got the log loan amount relative to the jumbo limit. The jumbo limit is specific to a year, and then we have the volume of applications. We could get this a similar graph with the volume of originations, and what you see here is that there's a very large amount of bunching because the vertical axis is in logs. So going from 13 to 14 is a fairly large increase in the number of applications, and then we see a drop in the volume of applications in the jumbo segment. We also see that when we look at approval rates tend to be relatively high right on the left side of the conforming limit and drop precipitously on the right side of the conforming limit. So there's a fairly large amount of bunching. This is just a baseline discontinuity here. And so it suggests that lenders see that there is a value to the securitization option, and that they're very conscious of the conforming limits. So it is, in a sense, a way to show that securitization has a value for the lenders. Now, on the left-hand side here, I've put securitization rates. So HAMDA has information about the purchasers of mortgages and whether the purchaser is a GSE. So on the left-hand side of the conforming limit, we see that the securitization rate drops when we move to the right-hand side by about 30 percentage points. And on the right-hand side, we see by matching the data to the liquidity of lenders on their balance sheet, we see that those lenders that are originating conforming loans have much less liquidity. And that those lenders that are originating jumbo loans have much more liquidity on their balance sheet. So likely they're more likely to take the risk of climate shocks onto their balance sheet. So we can also see as a baseline the fact that foreclosure rates are higher for conforming loans, and that the hazard rate of a payment incident delinquency of foreclosure is also higher for conforming loans. So this slide has been very contentious. I gave a presentation with Fannie Mae and Freddie Mac economists, and it leads to a lot of debates. But this data has been used by a number of researchers, so we believe that these results are easy to replicate. This is the main specification of the paper. This is specification called number 1, where we, on the left-hand side, we've got outcome variables like the probability of approval, we've got the probability of securitization, and the probability of origination. And we saturate the regression with a set of controls. So we've got a dummy for below the conforming limit that captures sort of the baseline discontinuity. I indexes mortgages. Then we've got the interaction between treatment dummies pre and post natural disaster. So T is the time relative to each of the 15 natural disasters that we have. We also have measures of the evolution of the discontinuity at the conforming loan limit over time. So for instance, Katrina happens in 2005, and it's just 2 years before the housing market meltdown. We need to control for this in the regression. So we saturate the regression, and those delta I's here evolve as we'd expect. That, you know, you see it during the 2020 pandemic, that there's a relative collapse of the jumbo market. And so that's those coefficients capture this. Our coefficients of interest are going to be the deltas here. They measure the impact, and that's why it's treated times time, measure the impact of the natural disaster on the discontinuity. Controlling for the market-wide evolution in the discontinuity, controlling for year fixed effects, controlling for zip code fixed effects. And we think that's really important. I'm going to speak about this in a second, because it means that we're controlling for the known historical frequency of hurricanes in a specific zip code. So we're going to focus on mortgages that are in a 95 to 105% window around the conforming loan limit. And we're going to change that window. We're going to narrow it down to see whether the results are robust to that. And we're going to expand the window to see whether it's robust to this. So two sources of identifying variation. The first source of identifying variation is the fact that NOAA tells us that although they can forecast the strength, the intensity of a hurricane season, they say that's where the reliable long-range science stops. The ability to forecast the location and strength of a landfalling hurricane is based on a variety of factors, details that present themselves days, not months ahead of the storm. So the idea here would be that the housing market at a very granular level doesn't have the ability to endogenously prepare for a hurricane once you control for zip code fixed effects and all of those saturated controls in the regression. The second source of identifying variation is the fact that conforming loan limits are set at the national level every year by EHHF, and so they're not endogenous to the local conditions. They are not set by EHHF, taking into account the specific climate risk in a county. So because they change, that means that the discontinuity bites at different points of the distribution of loan amounts. The second regression we have is a regression in numbers, because the first regression looks at the probability of approval, the probability of origination, but what about just the sheer number of mortgages? So there, we just take the difference in the number of loans below the limit minus the number of loans above the limit, and we divide by the sum of the loans. So it's a measure of the magnitude of the discontinuity in terms of numbers. And then we also saturate here the regression with disaster fixed effects, year fixed effects, zip code fixed effects, treated times time, and that's going to be our coefficient of interest here, which is the impact of the treatment, which is being hit by a hurricane after the hurricane. And so what's nice with both of the specifications is that we have a placebo test in terms of pre-trends. We can look at whether there are pre-trends, and we don't find those pre-trends. And the second thing we can look at is whether the effect is at the discontinuity. So we also have placebo tests in the paper, changing the discontinuity artificially to see whether the impact is right at the conforming limit rather than far from the conforming limit. So there's a lot of numbers in the paper. So in half an hour, I've been trying to really narrow down on the most important results. And one of the important results here is the impact on the probability of securitization. And we see that here, 3-4 years after the event, there is a 15.4, 15.5, 19.3 probability of securitization, higher probability of securitization. We can also see the adverse selection here going on, that after the event, there is a decline of the credit score by about 3.7, 3.4 points. There's some increase in the term of the mortgage. The mortgages tend to be longer. There is an increase in the foreclosure rate, 3.6 percentage points, 4.9 percentage points, and there's also an increase in the 30-day delinquency after the natural disaster. We also see that in terms of 90-day delinquency, 120-day delinquency, and voluntary payoff goes down. That those, so sort of unambiguously, there seems to be a decline in the quality of those mortgages. Now we look at those measures of numbers, the discontinuity in terms of numbers. This is specification number 2. And we see that there is an increase in the discontinuity in terms of applications, in terms of approvals, in terms of originations, and in terms of securitizations. So we have, if we want to do a counterfactual to understand what would be the amount of securitization in a world with increasing disaster risk, with and without the GSEs, but also with the GSEs and higher guarantee fees so that they can compensate themselves for the risk that they're taking on, that requires a model. And so I refer to the paper for the details of that model. That model is like an IO model of location choice, except here it's a mortgage choice. So there's J different locations with different loan amounts and different types of amenities. And people self-select into those bins, those J bins, based on their unobservable driver of default, epsilon here. And the goal of this model is to first reproduce the observed discontinuity. We want to observe the bunching, and we want to see whether we can then change disaster risk probabilities to see whether the bunching would increase and whether we would get as much bunching if we withdrew the GSEs from the model. So we can remove the GSEs from the model and simulate the equilibrium interest rates, equilibrium probabilities of approval, probabilities of securitization, and we can therefore see whether the GSEs have a stabilizing impact on the mortgage market in hurricane exposed areas. And what we see is indeed that when we dial up the disaster risk probabilities, that the market responds very little. The discontinuity responds little when the GSEs are present, but responds a lot when the GSEs are not present in terms of a decline in approval probabilities. So if we increase disaster risk, we see that there is a decline in the probability of approval on the left and the right-hand side, but there's also an increase in bunching. So we see a decline in the probability of approval, but also an increase in the discontinuity. And we see an increase in the probability of securitization on the right-hand side here. Now we can shut down the GSEs. That's a little bit, I apologize if I haven't cited the extensive literature on the topic. There is a very interesting paper called Phasing Out the GSEs that looks at the macro implications of phasing out the GSEs. Here we look at the micro implications of phasing out the GSEs here. And if we remove the ability to securitize and we increase disaster risk, we see that the amount of bunching pretty much disappears and the probability of approval declines much more than in the scenario with the GSEs. And of course, there's no agency securitization ability here. Then in the last part of the model, we simulate what we call profit neutral guarantee fees, which are guarantee fees that would maintain the profits of the government-sponsored enterprises to the same level as without increasing disaster risk. And we find guarantee fees that are these are ongoing guarantee fees. When looking at the guarantee fee schedule, there's upfront and then ongoing. Here, this is as if everything is ongoing. And we see that the guarantee fee needs to increase as the probability of a disaster increases from 0% to 1.5%. The other way that the GSEs can adapt, and that's not modeled in the paper, but we have some interesting empirical results that are not yet in the NBR, that is about transferring the climate risk to private sector investors using credit risk transfers. So Fannie and Freddie could be seen, and they've been seen for a long time, as taking on the risk on their balance sheet, but increasingly they have been issuing credit risk transfers, which means that Fannie and Freddie are more middlemen between the private sector and the lenders, and are just transferring this climate risk back to those investors. So here, just a little preview of what we find here, because Fannie Mae has made available data on what is called Connecticut Avenue securities, which are some of those credit risk transfers. And we can correlate the amount of credit risk transfers with hurricane frequency. And there we find a negative correlation. That is, we find that there is a lower amount of credit risk transfers in places with higher hurricane frequency. The correlation is not very large, but it's negative, suggesting that there's a little bit of negative selection. That is, there's less hurricane risk among credit risk transfers than among the entire population of mortgages here. So the GSEs have a lot of ways to adapt. I think one of the challenges here is to understand the political constraints. One of the arguments that I've heard repeatedly is that the GSEs do not want to be pricing geographically their guarantee fees, because they do not want to wake up the ghosts of redlining and the issues of essentially pricing mortgages based on the demographics of neighborhoods. And I think this is a really difficult question. And I think as economists, I don't know if we're equipped to deal with this question. And I think it's going to be an ongoing debate. So this paper is part of a research agenda, and I think we're not going to stop here. We're going to, one of the questions we want to ask is whether Fannie and Freddie, and also private label securitizers, provide a service by diversifying climate risk, by pooling those mortgages. And as you were saying, as you were asking, Johannes, about whether this climate risk is a sprinkle across a large number of pools, or whether it's concentrated. And I think there's a question about whether climate risk is going to be a fault line, to borrow the words of Raghu Rajan. And that's part of our research agenda, understanding how mortgage-backed securities can help us in mitigating climate risk. Then there's questions about whether private counterparties adapt to the rising default risk, whether private label securitizers charge for that. And then there's really typical questions of finance about whether climate risk is a tail risk, and whether there's a climate equity premium puzzle here. And so we've got some ongoing work about how climate risk speaks to the key questions of finance. Does it affect the fundamental theorems of asset pricing? And I think each of the papers of today, maybe that's a conclusion, if each of the papers of today have been looking at a corner of an asset pricing model where climate risk is affecting opportunities of arbitrage, is affecting the pricing, and I think this is really this been really an exciting day for us to look at all of those papers. So thank you very much. I hope I didn't exceed my time.
Perfect. No, thank you so much. And I think this very last slide is really where we want to go in the discussion now, because I think I think the idea of this class is sort of to start out by presenting a bunch of either more seminal established papers, but really in this field, because it hasn't been around very long, a bunch of current research, but then also really talk about where we all want to go next. What are sort of the central elements, and I think there's, a lot of commonality. For example, this question here, is this a tail type risk or is it conventional volatility? This closely links to the presentation Stefano gave about when you want to think about, this type of risk, how do you model it? What's sort of the structure of the risk? Ambiguity keeps coming up, and I think ambiguity to the extent that you want to think about ambiguity and ambiguity aversion and asset pricing, it seems like climate change is sort of an obvious place where this is going to be important, precisely because even the physical scientists disagree a lot. There's a lot of uncertainty about the processes there. And so that makes ambiguity a very natural thing to introduce here, maybe more so than for, maybe more standard consumption processes or something like that.